Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I'll give you an example. I think we've talked about a lot of this already, but in the long-term time frame, here's our global macro backdrop that we have, and here's what's shaping up right now. We don't think the U.S. consumer is going to pop back and be the demand driver he was. He's still busy repairing his balance sheet, losing about $16 trillion of wealth over the last 2 years. People are scared. People are afraid to spend. And the U.S. consumer is the driver of really everything globally. We're learning that in this recession. The question really long term is, will China generate domestic demand with their stimulus? And we really don't think they will. The stimulus money that they've spent and front-end loaded has gone into infrastructure projects and also some politically palatable projects for those that are connected. China is expecting a V-shaped recovery, and we don't think a fast recovery will happen precisely because of this guy. So this idea that China can stimulate domestic demand while using its stimulus in the infrastructure projects we think is really silly. Which means if China gets it wrong and we don't have a V-shaped recovery, China has wasted a lot of money, and it just added to capacity, which is going to add to deflationary backdrop in the world economy. Can German exports stabilize? German exports have declined dramatically because Germany, of course, is an export-dominated economy. And why have they dropped off dramatically? Because the U.S. consumer has dropped out of the picture. The other European countries are in trouble with their own demand, rising unemployment, credit crunch problems, Ireland, Iceland, all across Central Europe, the potential for defaults. Those countries are in trouble. So German exports have just fallen dramatically, and Germany has gotten hammered very, very hard beyond what any of the analysts would have expected. Most expected Germany to skate through this because they were, quote, a current account surplus country. Well, we're seeing what happens to the current account surplus country when the U.S. consumer no longer buys the stuff, when they rebalance, when the U.S. when the U.S. economy starts rebalancing its overconsumption and starts pulling back, everybody else gets in trouble. And we still think this is the key right here, and we don't see it rebounding very, very quickly. The real question here is, can emerging markets avoid default? And this is a key question because if the emerging markets do default on a China disappointment, it will ripple through the global economy, and we will get a major risk aversion flow back into the U.S. dollar. Again, not because our government's doing anything to protect the dollar, not because the U.S. is doing anything for the dollar or anything particularly healthy at the moment, but it's the only place to hide. So we're watching all this stuff for another major bounce in the dollar if it plays out. Right now, though, the reality is the dollar is getting whacked, and the shorter-term trend says we're back in the game of risk appetite, and you see that. You see that in rising stock markets and other things, and we'll get to those examples of those overlay charts that you can use to define this environment. The major themes are China stimulus is going to work. Everybody believes that China is going to pull everybody out of the fire here. Declines in demand are easing. Well, in some cases, we're actually seeing slightly less declines in growth. Of course, when you have an optimistic outlook, negative news, even slightly better than it was, even though it's very negative news, people will jump on and turn into a momentum trade if price is proving them right. And this is one of those rationales that they're using in this environment because people are optimistic, and we're seeing a bounce in the risk assets. Green shoots emerging. Well, they are emerging in some places, and there's no doubt we're seeing some places improve slightly. But when you look at the major economies around the world, we're not seeing improvement in the U.S. consumer per se. We're not seeing any improvement in German exports. We're seeing China's exports continue to get worse. We're seeing China import demand continue to decline. We're seeing the Japanese economy almost fall off the cliff. I think we had about a 15.2% annualized decline in the Japanese economy in the first quarter. 15.2% annualized decline. These are huge numbers. So yeah, there may be some green shoots out there, but there's some major questions that haven't been resolved. But that doesn't matter if perception can overweigh reality, and Steve will talk to this a bit, I think. In markets, perception is all that matters, because perception moves real people to move real money, and it doesn't matter if the rationale is flawed. If the price trend is going your way and your rationale makes sense because it's being validated by price, you tend to add more money to the trend, and we're seeing, I think, a bit of that here. It's hard to say when this type of stuff right here, which goes against our longer-term time frame, whether or not this short-term stuff that we call short-term stuff really may be a major trend change. Again, we don't know this with hindsight. So even though our most confident view may be here, we have to be open to the idea that a new trend has started, and we're very wrong on all this stuff up here. And that's what we use the set of intermarket analysis to watch this stuff and keep reflecting against our longer-term and our near-term view. Because obviously, if we're wrong, you're going to start. We will see it in price action. And we'll get to, and I'm going to show you some of the key things we look at that I think you can use very easily to track this stuff yourself. Of course, our idea of using these is just really to look for trade setups in currency markets. That's our concentration for using these key asset classes. We look at long-term, short-term. We look at them in isolation. We look at them against one another, which gives us information. And then we look at these key asset classes in relationship to the major currencies. From your standpoint, all you really would need to do is look at some of these key asset classes against the U.S. dollar index. They keep it very simple. They give you a thumbnail sketch of really what's going on. And again, we look at these in longer-term weekly charts and drop down the daily, and sometimes we use 240-minute charts to make this analysis of these intermarket relationships. I continue to stress this, and I stress it because I believe it, that the FX options are really a great way to play these environments. You know exactly what your risk is. You see these intermarket relationships starting to set up. Some of the other technical stuff makes sense, then you take a bet. You buy a put, buy a call. We keep it very simple. You don't have to get crazy with this stuff. You can get crazy with this stuff, and you can do anything you want, the butterflies and all that stuff, which I don't know very much about. But you can do anything with these that you do with any stock options. We tend to use them as making directional bets on the currencies, and if you use them that way, keep it simple. I still think you can make a lot of money in the currency markets if you get it right. I think that's happened to people. Intermarket stuff we follow. This is it. Again, we do this against a lot of the major currencies. You only have to worry about doing it against the dollar index if you want to emulate this stuff. Stocks. We look at the S&P 500, and we look at MSCI, Morgan Stanley Capital International, the emerging market index. I think the symbol is EEM, traded in New York or Amex, I forget. EEM is the symbol. Bonds. We look at the 10-year note futures, and we look at Eurodollars for the shorter end. Commodities, we look at gold, oil, and we look at the commodities index overall. Sometimes we'll look at other stuff, but in general, this is what we do, and this I think really covers the gamut of the major asset classes you need to watch to give you a feel for this ebb and flow of money in the global economy and changes in patterns of the risk environment. Let's get to some examples.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.